Yeah, you can start.
Happy evening to all of you. Welcome to today's online meeting on IND AS 110 consolidated financial statements. To take us through this topic, IND AS to this accounting standard, we have with us CA Anand Subramanian sir. On behalf of SIRC ICAI, we welcome you, sir. We have also with us CAS Panara sir, the chairman of SIRC ICAI. We welcome both of you, sir. We will start today's proceedings with the invocation of ICAI Motor Song.
यैष सुप्तेषु जाग्रति यैष सुप्तेषु जाग्रति कामं 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 कामंशो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्लं तद्ब्रह्मा तदेवामृतमुच्येवामृतमुच्यते तस्मिन् लोकः शितः सर्वे कश्चन एतद्वैता 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 एतद्वैता.
Thank you. May I now request Panara sir to give us welcome address.
Good evening and warm welcome to all the participants and as well as the erudite speaker for the day, Mr. Anand Subramanian sir. And you all know that today's topic is IND AS 110 on the consolidation of financial statements. And it is one topic which is very important in the area of IND AS because it is the document which is viewed by the public and they will try to understand the consolidated figures of the entity. And we at SIRC have the ideas of doing the IND AS industry specific also. Some of the topics. For Anand sir, for your information, there is a demand for what's called industry specific IND AS compliances also. For example, garment industry, steel industry like this. This is mooted by some of our members and it has come and reached to me because of the other engagements. We have been following them bank audit this summer season and now this July 1st day and all these things, and we will definitely take up in the near future. I request you also to help us out in taking up the topics and industry specific. This one, we will try to find out the numbers of the members who are interested in each segment like that, and that will be very useful. And in general, at SIRC, my focus as a chairman of SIRC is more on inclusive growth in the sense the smaller and medium practitioners are falling behind in this technologically advanced areas, advanced era. For example, even GST and all these things require what's called a very advanced technology, even filing of the IT returns and all. So we are focusing more on that because the compliance practice is fading away. We also are concentrating on what is called the widening of the professional opportunities, newer opportunities, for which we depend on the MSME sector. So these are the two prime areas we are working on. Recently, on 15th and 16th of this month, we collected 3 to 4 people from 4 members who are technically what's called basically having basic knowledge and good at computers also. We trained them for 2 days to become faculty to how to use technology to perform their professional responsibilities in a more accurate way and more faster pay faster pace. So that will in turn, they will in turn go to their branches and they will do workshops to the members and students as well to see that this 23-24 financial year, what all compliances are to be done. That is, the burden is reduced because the number of article students availability is drastically reducing. That is one area, and second area is widening the practice areas through MSMEs, and that is we are doing in commemoration of the International MSME Day that is being celebrated across the globe on 27th of June. We at SIRC have conducted 2 days work conclave on MSMEs on 24th and 25th of this month, not to clash with the 27th celebration by ICAI at Mumbai. Startups conclave is happening at Mumbai, so not to clash with that. We are doing it on 24th and 25th at DG Vaishnav College, Arumbakam. I request the members to reach out to the website and register yourself and get to know the constituents that are involved in MSME segment. Even there also, there may be companies to which IND AS may be applicable. So how to switch over from what is called compliance practice to business advisory practice. This would be very helpful, and also to understand the ecosystem that is available for MSME segment as such. That is, what are these incentives by union and state governments? What are the bank facilities that are there? Who are the entities who will support you for your business ideas? And who are the entities who are supporting with the technical support of machinery required and all, and marketing and raw material like procurement through NSIC, like that. All the segments are involved. All the what's called constituents of MSME are involved in this. So I request the members to register and also send your office assistants on registration to this 2 day national conference on 24th and 25th. In these words, I think I took extra time to dwell upon the SIRC activities and the registration for MSME. Please bear with me, and thank you, Anand sir, for accepting to be a speaker. And sorry for intervening too much into your time. And wish you all a very happy learning. We'll be in touch with you for future programs, sir. Thank you, sir.
Absolute pleasure, and you know, from my perspective, although this is an important topic, the activities which is being carried out by SIRC is more important, given that it's a year-long kind of an activity which happens with each month interspread in between, and therefore, I will try to cover it up comprehensively within the time allotted. Not a problem. Thank you.
Thank you very much.
Thank you, Chairman sir. We will get into the session now. It's my pleasure to introduce Anand sir. Anand is a member of our institute. Presently, he is a partner in the audit and assurance practice at Deloitte Haskins and Sons LLP, with over 22 years of experience, and is based in Bengaluru. And he specializes in IFRS, IND AS, US GAAP, and SEC reporting. Anand is the US Professional Practice Director for India and is a member of the Asia Pacific Financial Instruments Center of Excellence. Anand has worked for 2 years on secondment in London, UK, and advised clients in the application of IFRS, US GAAP, SEC, and other regulations in connection with the US and UK capital market transactions. He has worked with a number of SEC registrants, including clients in the technology and automotive sector, and has significant audit experience in performing audits under Public Company Accounting Oversight Board standards, SEC rules and regulations. He has administered a PCAOB inspection process in India since 2013. Anand is also a member of the Global Capital Markets Group and leads the internal inspections of SEE registrants and multinationals in the Asia Pacific, Europe, and the United States. He is also a member of the SEBI Working Group for Real Estate Investment Trust and Infrastructure Investment Trust in India. He has worked with Infosys, Tata Consultancy Services, ITC Infotech, Brookfield India, Tata Motors, Maruti Suzuki, HDFC, Standard UK, Abe National, Bharti Airtel, Indus Towers, Tata Communications, Vodafone UK and India, Wipro, to name a few. With this brief, I present before you CA Anand Subramanian sir to take us through Indian Accounting Standard 1110. Over to you, sir.
Thank you, Rahman. I think you have been very generous as far as what I did over the last 22 odd years. But just to sort of give a background, I work out of the Bangalore practice of Deloitte, and mainly take care currently the audit engagement of Wipro. So I'm the signing partner for Wipro Limited. And prior to that, I was handling Infosys. There is a rotation rules which apply every 5 years as far as SEC independent rules is concerned, and that's why I rotate off within the firms. My areas of expertise is, all accounting standards relating to IFRS, Companies Act, rules and regulations of SEBI, and also the SEC rules and regulations, given that I predominantly work with US filers. What I would go through today is on IND AS 110, and let me share the presentation with you first. But as I go through, if there are any comments, please share it in the chat box, and I would try to answer either in between or at the end of the presentation. Just to sort of give a bit of background about IND AS 110. India adopted IFRS, or rather IND AS, the converged standards of IFRS in 2017, with the opening balance sheet being 1st of April 2015. The consolidated financial statements, or what you would call IFRS 10, actually came into being somewhere in 2010-11. And if you go into why that standard was rewritten, the earlier standard under IFRS was IAS 27, and IAS 27 was replaced with IFRS 10. So I'm now going back into a little bit of history, almost 13 years back when the standard was written. And why the standard was written is, if you would all remember, in 2008, there was a global financial crisis which resulted into the fall of Lehman. RBS, which was Royal Bank of Scotland, was taken over by the UK government, and therefore it became a government-owned entity. ABN AMRO, which was again a bank which was owned by the Dutch government, was partly taken over by the UK government, even though it was acquired by Royal Bank of Scotland. And then there were various other sort of financial collapses which happened in Europe and US. At that point in time, in 2008, when this happened, one of the recommendations of the Treasury and in fact the G7 at that point in time and G20 was that some of the standards which were written were redundant from an IFRS perspective and were required to be rewritten. That's why the need arose to rewrite the standard on IFRS 10. And the reason why that need arose was because there were collateralized arrangements which were in place. There were borrowings and guarantees which were given to off-balance sheet entities. And these collateralized arrangements and off-balance sheet arrangements resulted into, banks and companies being called upon to fund the losses for those collaterals calls which were made as far as those particular entities were concerned, which then resulted into the off-balance sheet exposure resulting into an on-balance sheet exposure, very similar to what a bank would give as a guarantee or a letter of credit. So similar to that, there were these off-balance sheet arrangements. And when the regulators looked into these aspects, they realized that by giving those collateralized, sort of securities or guarantees, practically the entity which gave the collateral or the guarantees were managing those entities, right? They were having a risk and return which was disproportionate to what you would generally have in a banking kind of an arrangement. And therefore, there was a fresh need to look into those kind of arrangements to see how those could come into the net, right? And that's why the entire standard was rewritten. Uh, India adopted the standard in 2015 with the first IND AS financial statements coming into play in 2017. And as we go through some of the concepts in the next couple of hours, you would see in terms of why the requirement, what the requirement, and why some of these standards are complex and therefore would require extensive consultations as and when you come across either as an industry expert or as a practitioner as you implement some of the sort of complex IND AS accounting standards at this point in time. The institute has done a fabulous job of providing educational material as far as these standards are concerned. But we continue to see a lot of consultations relating to consolidations, relating to common control transactions as far as business combinations is concerned, relating to financial instruments. And what you would see over here is probably a tip of the iceberg, given the complexity of the standard. And I will try to make it as lucid as possible. But I just wanted to give you a background in terms of how the standard arose before we sort of delve into IND AS 110 in detail. All right, so with that, let me start off. What is it that we are going to cover today? We are going to cover what are the suite of standards which was introduced due to the change, and what we are going to cover today. If you would look, the suite of standards which was introduced was actually IND AS 110, IND AS 111, and IND AS 112. So these are the three suite of standards which was introduced together, and it sort of complemented the existing standard on IND AS 28. As far as India was concerned, all of that was implemented or adopted effectively on the same date. But if you go into the history, the relevant standards which are important is basically 110, 111, and 112. We also go through the objective and scope of the standard. We will spend considerable amount of time on the concept of group and control and assessing control, because this is something which is really, really important. This is where a significant amount of complexity comes in, given the multitude of entities which you would deal as a practitioner and which you will deal as an industry. And I'll try to touch upon some of the examples, some of the concepts along with examples. And you would see that, it can become very complicated, right? Because there is a significant amount of judgment. Accounting for changes in ownership interest. So what happens once, you have a change in an ownership interest? And I'll try to cover that in two aspects: what happens under IND AS 110 and what happens under the other accounting standards once a change in ownership interest happens. Then we will have concepts on investment entities, the consolidation procedures, the presentation and disclosures, and then we will also have consolidation of funds, which is again a concept which is introduced new through IND AS 110, but something which I think I should cover. If you would ask me, this itself is a topic which we should cover as a separate topic, given the complexity which you would deal with. But I will give you some real life examples of what you would see in India, which is available in public domain for you to assess. If you would want to sort of see information in the public domain and relate it back to how each of the industry or each of the companies have assessed these particular transactions under IND AS 110. So with that, I will move on. So as I said, what is the suite of standards which you talk about? The first one is IND AS 110, which is dealing with consolidated financial statements. IND AS 111, which deals with joint arrangements, right? Then you have IND AS 28, which deals with investment in associates, accounting for investment in associates, and IND AS 112, which deals with the disclosure requirements relating to joint entities, right? And this not only include joint arrangements, but also where you are another entity in a joint arrangement. So these are the suite of standards, as you would call, and therefore you'll have to follow a decision tree, which I would briefly discuss about in the next slide, in terms of how do you evaluate, a particular transaction under these suite of standards. So if I go to the objective and the scope of IND AS, the objective and the scope of IND AS is obviously to prepare and present a consolidated set of financial statements. And you present a consolidated set of financial statements when one entity controls another entity. It's very, very important for the practitioners, the people who are attending today, to understand that the concept of control under IND AS 110 is a concept of a unilateral control. So for example, if Anand controls an entity, right, or Mr. X controls an entity, Mr. Y cannot control an entity, right? Mr. Y and Mr. X can have a joint control over an entity, but the concept of consolidation under IND AS 110 always envisages a unilateral control. So, for example, in this particular instance, it is basically Tata Sons controlling TCS, as an example, right? Or the Aziz Premji Foundation and the Aziz Premji Trust controlling Wipro, as an example, right? Or for that matter, let's assume, if I would talk about a significant influence, Tata Sons having a significant influence on Tata Motors, as an example, right? Or the Brookfield Group is got a controlling entity over the Brookfield REIT, as an example, right? So these are examples where there is a unilateral control, and therefore the concept of control is always unilateral. If it results into a joint control, then you would fall outside the scope of IND AS 110 and fall into IND AS 111, right? Now, what does IND AS 110 comprise of? It essentially defines the principle of control and establishes control as the basis for consolidation. And therefore, we will look into the three parts of control, which is very, very important. The way the revenue recognition standard is a 5-step standard, right? The concept of definition or the definition of control under IND AS 110 is a 3-step definition. And therefore, we will follow and understand what those 3 steps are, right? It sets out the accounting requirements for the preparation of consolidated financial statements. It's got an exclusion exemption, which means that if you are an investment entity and if you predominantly evaluate your subsidiaries only on a fair value basis, and the investors of that entity which essentially has invested in that subsidiary, for example, let's assume there is entity X, and entity X has got, let's assume, 4 investors, which is entity A, or investor A, investor B, investor C, and investor D, each holding 25% in entity X. Entity X is invested in entity Z, right? And entity X is a listed entity, right? Technically, it should be consolidating entity Z, right? Assuming it's a wholly owned subsidiary or it's a subsidiary. But if all the 4 investors of entity X, right, evaluate the investment by entity X in entity Z only on a fair value basis, and there's an exit option which is available for each of the investors, and their predominant purpose of holding the investment is to have capital appreciation or return in the form of dividends and nothing else, right? You have an exemption available to be categorized as an investment entity. And if it is an investment entity, then entity X doesn't need to consolidate entity Z. In that particular instance, entity X will show this investment at fair value under IFRS 13 and under IFRS 9. And that is how it will get accounted for, right? So that's basically what the exception of consolidating under investment entity guidances, right? Now, this standard does not deal with business combinations, and that is covered separately through IND AS 103, right? So, when do I need to prepare a set of consolidated financial statements, right? I need to prepare a consolidated financial statements when the parent has got one or more subsidiaries, except, right, when certain conditions are met. So the conditions which is required to be met in all instances is as follows, right? That assume that the parent, right, has a wholly owned subsidiary, right? And that wholly owned subsidiary, right, has other investments, which again is a subsidiary. For example, let's assume entity A is a listed entity. Entity B is a wholly owned subsidiary of entity A, right? In that particular instance, and assuming that entity B has got other subsidiaries below that, right? In that instance, entity B, assuming it is a wholly owned entity, doesn't need to prepare a set of consolidated financial statements of entity C, assuming that entity A prepares a consolidated set of financial statements. Or take an example where entity A holds entity B, right? And the holding percentage is approximately 60%, and the remaining 40% of entity B is held by NCI or non-controlling interest holders. And entity B has got another subsidiary called entity C. In that particular instance, right, entity B has to prepare a consolidated financial statements with entity C unless the non-controlling interest holders of entity B also confirm that they don't need a consolidated financial statements, right? So if you are a wholly owned subsidiary, you have an exemption of preparing consolidated financial statements. If you are a partially owned subsidiary, you have an exemption only when the non-controlling interest holders agree to it, right? Further, that wholly owned subsidiary or the partially owned subsidiary should not have an equity instrument or a debt instrument which is traded in the public market. For example, in my instance, a wholly owned subsidiary, let's assume, has got a debt which is listed in a public entity, then that wholly owned subsidiary still would need to prepare a consolidated financial statements, right? Or assuming a partially owned subsidiary is got, let's assume, a listed equity, right? And I'll give you a real life example, right? Questcorp Holdings is an entity which is a listed entity. The subsidiary of Questcorp Holdings is Allsec Technologies. Now, Questcorp Holdings holds approximately around 70% in Allsec Technologies. The remaining 30% is basically held by public shareholders, right? Now, assuming Allsec Technologies has got subsidiaries, in that particular instance, Allsec Technology would also need to prepare a consolidated financial statements, and Questcorp should also prepare a consolidated financial statements, right? So that's the way the entire standard has been written. So you need to follow all the conditions for you to get the exemption if you're an intermediate subsidiary of a listed entity, right? Or if, let's assume that subsidiary is in the process of listing or essentially raising any funds from public, then again you don't get an exemption, right? Now, its ultimate or any intermediate parent produces consolidated financial statements that are available for public use and comply with IND AS. So it's very, very clear, right? So for example, the requirement is for you to comply with IND AS. And therefore, if these conditions are satisfied, then to that extent, you don't need to prepare a consolidated set of financial statements, right? Now, the other aspect is, right, you don't consolidate a post-employment benefit plan, right? The reason why you don't consolidate a post-employment benefit plan, and let me give you an example, right? Let's assume that, you know, entity X, or in this particular case, let me give you an example, TCS. TCS essentially has got you know, uh, you know, investments, TCS essentially funds its employee benefit plans or its gratuity plans essentially through a trust, right? Now that money which is to be contributed for the gratuity is paid by TCS to the trust. The trust then invests that, right, into securities so that it is adequately funded. And if necessary, TCS will fund them as and when it is required. And that investment is managed by the trust. Now, under IND AS 19, if you would remember, there is a requirement to essentially, show what is the net benefit or the net surplus as far as the trust is concerned, which is done based on IND AS 19 in the balance sheet. For example, what you would show is, let's assume if the fund liability of the trust is, let's assume 10,000 crores and the fund assets is 10,100 crores, then you would say that there is a net prepaid asset of 100 crores, right? Assume the opposite, where there is a liability of 10,000 crores and there is a fund asset of 9,900 crores, then you would say there's a net defined benefit liability of 100 crores. But in the disclosures, which is there under IND AS 110, you would show the total fair value of the fund assets, which is 9,900, the fair value of the fund liabilities, which is 10,000, and then show the net difference as 100. The 100 gets reflected in the balance sheet as a net item, but in the disclosure, everything gets presented. Now, this is irrespective of whether this is a trust which is held by the standalone entity or there are multiple trusts where there are subsidiaries of the trust which is getting involved, right? And given that there is a separate standard which takes care of the accounting which is required for the employee benefit plans, there is an exemption which is available for consolidation under IND AS 110, right? Now, as I discussed, an investment entity, given that the entire investment is measured at fair value under IND AS 109, you don't need to consolidate that entity, right? Now, what is the exclusion to exemption? Right? The exclusion to exemption is that, let's assume that I am a service provider to that investment entity. What that means is an investment manager which provides services to that investment entity. Or let's assume there is one more entity which provides services, right? It's a management entity. That entity, there is no exemption to consolidate under IND AS 110, right? And the holding company or the investment company, which is not an investment company. For example, let's assume there is a holding company, but the holding company itself is not an investment entity. Then in that particular instance, again, the holding company, right, would need to prepare a consolidated set of financial statements, but the investment company, which is a subsidiary of that holding company, and the sort of step down subsidiaries, whatever is that value, that will then get carried forward to the holding company. But if there are other companies within the holdco, then all of that would need to get consolidated. So this is the way the standard has been written. This is the scope of the standard. If there are any questions at this point in time, Rahman, do you think it makes sense for us to open up at this point in time or later? How does it work? Rahman?
Yes, sir.
Yeah. Do you think it makes sense for us to open up at this point in time, or we can do this discussion later in terms of any questions?
Okay. Okay, sir.
All right. So if there are no questions at this point in time, I'll continue. And let's sort of take questions at the end. If there are any questions, please put them down in the chat box for me to take a look once I finish the presentation. Right. So let's take an example in terms of how do we sort of put the scope into practice, right? Now, in this particular instance, entity X owns the following other entities: 100% interest in entity Y. Entity Y owns 60% entity interest in entity Z, 80% interest in entity M. Entity M owns 60% interest in entity M. Now, entity X is a listed entity, and therefore it needs to prepare a consolidated financial statements. Entity Y and M are not do not have any securities which are publicly traded, and they are not in the process of issuing securities in public markets. So this is facts, right? Entity X does not require its subsidiary M to prepare consolidated financial statements because it is wholly owned, right? Entity Y is a wholly owned subsidiary, and therefore it doesn't need to prepare consolidated financial statements. As far as entity M is concerned, right, if the non-controlling interest holders of entity M also agree, then entity M doesn't need to prepare a consolidated financial statements with entity M, right? Now, there could be various regulations, and those regulations may dictate in terms of what you should be presenting as far as an intermediate parent entity is concerned. And therefore, if there are any additional regulations which you would need to sort of abide by, for example, let's assume SEBI regulations, or for that matter, let's assume regulations as far as RBI is concerned, then you should be taking that into consideration apart from IND AS for you to determine whether, you would need to, whether the exemption will apply or not apply, because these exemptions technically will apply to a company which is registered under the Companies Act. But let's assume you are a REIT, right? Now you would be determined by the REIT regulation. If you are an InvIT, then you would be determined by the InvIT regulations of SEBI. And therefore, if there are any additional regulations, you would need to follow the regulations and not only restrict yourself to what is there under IND AS 110, even though you may be complying with those specific requirements, right? But if you need to have the exemption, you need to comply with the requirements of scope exemptions under IND AS 110, right? If I go to the next slide, let's discuss some of the key concepts as far as IND AS 110 is concerned, right? So what does consolidated financial statement mean? A consolidated financial statement would mean, right, the balance sheet, the income statement, and the cash flows, the statement of changes in equity, and that statement technically is defined as far IND AS 1 is concerned, right? Now, parent is an entity which is controlled, right, which controls one or more entities. Subsidiary is an entity which is controlled by the parent, and group is nothing but a parent and its subsidiaries. So a group does not consist of an associate, right? It does not consist of an entity which is either a joint operation or a joint venture, right? A group always would mean a parent and its subsidiaries, right? Now, a non-controlling interest is basically an equity in a subsidiary which does not belong to the parent, and therefore it is shown as an equity, but it is shown under non-controlling interest as a separate line item as far as Schedule 3 is concerned, and also as far as IND AS 1 is concerned, right? Now, what is power? Power is the current rights or the existing rights that give the current ability to direct the relevant activities. So what that means is, if I'm able to direct the relevant activities through the power which I have, right, then basically one of the definitions of control is satisfied. And when I talk about power, it's basically not only the power not only is basically an active power, but it is also a passive power. And I will talk about that in some time from now in terms of what active power and passive power is through examples, right? Now, the second aspect is protective rights. So generally, you would associate protective rights with non-controlling interests. For example, you would have currently seen the SEBI LODR regulations, right? The SEBI LODR regulations essentially states that if you are doing a slump sale at this point in time, right, the slump sale would need to be approved by a majority of the minority. So protective rights essentially doesn't hamper the ability of one entity or one individual or a group of individuals collectively to control that entity, but it gives you the ammunition to ask the relevant questions, right? So these are considered to be protective in nature. For example, let's assume approval of dividend, right? Now, assuming that an approval of dividend requires a minority approval, right? It could potentially be both a participative power as well as a protective power, depending upon the situation, right? What it is. And I'll talk about protective power in some time from now with examples. But the largest area of judgment is what are the protective rights and whether those protective rights prevent other parties from controlling an entity, right? This is very, very relevant when there are 2 or 3 significant shareholders, right? When there is a government which is essentially getting involved as a shareholder, right? That could be Ps who could essentially invest in an entity and could have those protective rights or could have the participative rights. And therefore, evaluating the agreement, evaluating the act, evaluating the other sort of related documents, including the past voting percentages, etc., become very, very relevant to determine whether an entity has got control over another entity or doesn't have control, right? Now, the standard also introduces something called as a relevant activity. Now, what is a relevant activity is what is that activity which is most important to an entity and how that activity affects the returns of that entity, right? And we would talk about that in some detail from now in terms of what those relevant activities are. And I will sort of give you real life examples in terms of how relevant activities could change over the period and how relevant activities are something which is really, really important, right? Now, the definition of relevant activity is important because the power over the relevant activity, right, for me to affect the variable returns is something which is important for me to determine whether I have control or not, right? And therefore, power, relevant activities, and protective rights are the cornerstones of whether you control an entity or not, right? Okay, so now if a subsidiary has got a if a subsidiary, right, a company which has a subsidiary on the last day of its accounting period must prepare consolidated financial statements in addition to its own individual financial statements. So as I said, if the entity has got a subsidiary on the last day of the financial year, still it needs to prepare a consolidated financial statements because obviously the balance sheet would get reflected as far as that is concerned. For example, an entity acquires an entity on 31st March of an accounting year, you still need to prepare the consolidated financial statements, although the profit as far as that entity is considered to be is expected to be minimal. You will still have assets and liabilities of that entity coming through into the consolidated financial statements, right? And consolidated financial statement comprises of financial position, balance sheet, the income statement, the statement of changes in equity, cash flows, and the notes to accounts. So what's the concept of group and control, right? Now, as I said, group consists of parent and its subsidiaries, right? Subsidiary is an entity which you are controlling as a parent, right? And you're pretty familiar with this. It is the concept is very, very similar to what you had earlier under the Indian standards. And given the sort of evolving nature of IND AS, you know what is a parent and a subsidiary at this point in time. So I will not dwell into that with much details, right? Now, usually when you prepare a consolidated set of financial statements, right, what you represent is how the entire group's performance is taken as a whole, And therefore, if there are any intercompany transactions, these are eliminated, except the tax effects of the intercompany transactions, which we will talk about in some time from now. You follow the same accounting policies and the same currency for the purposes of presentation. And therefore, let's assume if Tata Motors has got JLR and Jaguar Land Rover has got a functional currency of GBP, right? Even though the separate financial statements and the consolidated financial statements of Jaguar Land Rover would be prepared in GBP. For the purposes of India, Tata Motors would prepare its consolidated financial statements, right, with under Indian rupees as a presentation currency, right? Now, Tata Motors functional currency itself is INR, but when it prepares its financial statements, it will prepare the financial statements under the presentation currency of INR. Similarly, when you're talking about Tata Steel presenting its financial statements along with Chorus, even though Chorus's financial statements is prepared under GBP, the consolidated financial statements should be prepared under INR as far as Tata Steel and Chorus and all its subsidiaries put together is concerned. The same thing with TCS, the same thing with Infosys, or the same thing with Wipro, right? Or any other entity which you would see, right? Generally, you would have the same financial year end as far as the subsidiaries is concerned. There are two ways of tackling this. Generally, all financial statements are prepared on the same date, even though the subsidiary financial statements could be of a different date, right? You would need to prepare financial statements of the subsidiaries, on the same date. Generally, this is done through a consolidated set of trial balances. The consolidated set of trial balance will have the subsidiaries on the same date as the parent, and therefore, from that particular perspective, all the intercompany elimination takes place for you to prepare the consolidated set of financial statements, right? Now, how does the standard work? If you have control, you would see on the left-hand side that you would prepare a consolidated financial statements and the disclosure requirements. Then you would go to IND AS 112. If you don't have control, then you evaluate whether it is a joint control, right? If it is a joint control, then you go under IND AS 111 and determine whether it is a joint operation or a joint venture. If it is a joint operation, then you would account for your share of your assets, liabilities, revenue, and expenses. And there is a catch over here, right? If it is a joint operation, then even in the separate financial statements, right, which will be called as separate financial statements, you would present the joint operation in the separate financial statements, and that same joint operation then would also be presented under the consolidated financial statement. And I'll give you an example, right? Tata Motors controls or Tata Motors jointly controls Fiat with Fiat, Italy. In that particular instance, if you open the annual report of Tata Motors, in the separate financial statements of Tata Motors, you would present FIAPL or Fiat India Private Limited being presented as a joint operations even in the separate financial statements and also the consolidated financial statements. The reason being that the joint operation standards would mean that it is as if that entity is an extension of your own entity. And therefore, from that particular perspective, even though legally Tata Motors is different to FIAPL, you would present the share of Tata Motors in FIAPL in the separate financial statements, and the same thing then carried forward to the consolidated financial statements. If it is a joint venture, then you would go under IND AS 28 and then equity method the joint venture, right? So it's pretty unique, right? Now, you have a choice under IND AS 28 to even account for the joint venture, right, under IND AS 109 under the fair value method. And therefore, if an entity elects to account a particular class, right, of entities, for example, all the entities which is accounted under the significant influence under IND AS 109, then you can account it under IND AS 109. And therefore, if it is accounted under IND AS 109, then you don't need to equity account it. So this is this is how you would essentially, consolidate the entities under IND AS 110. And therefore, as I said, this is a suite of standards. And therefore, if you don't fall under one, you need to evaluate whether it falls under anything else. And if it doesn't fall under anything else, then it is purely treated as an investment and accounted under IND AS 109. Right? So it's got a linkage not only to IND AS 110, 111, 112, but it's also got a linkage to IND AS 109, which is the recognition and measurement of the investment under the financial instrument standard, right? So if I go subsequently, consolidation is based on control. Control may be obtained in various manners. So the practitioners who are listening to this CP should remember that the traditional forms of instrument which gives you control, right, have not gone away. And therefore, if I own, let's assume 60% controlling interest in an entity through shares, right? Fine. So an instrument like an equity share, right, is a form of an instrument which gives you control, right? But you should also remember that potentially there are other instruments which gives you control, which may not be an equity share. For example, a warrant. For example, a convertible debt. For example, let's assume a preference share, right? For example, a non-convertible debt, right? For example, only a loan, right? A pure loan. And I'll give you examples in terms of how a loan could potentially result into a control, right? I've given money to an entity and that could result into a control. And therefore, somehow we should sort of think about the definition of control holistically and not only think about the traditional instruments which gives us control, but also a plethora of new instruments which could then result into a control of one entity over another entity, right? The other thing which you should remember is the linkage of power to risk and rewards. And the risk and rewards could be either positive or it could be negative, right? And I'll give you examples in terms of what negative risk and rewards are. And I'll also give you examples in terms of variable returns, right? And the variable returns essentially not being a financial return, but could also be a non-financial return and how that could happen, right? So these are some things which is really important. And as we go about, I'll give you practical examples in terms of how these are taken into consideration, right? Now, as I said, right, there are three aspects of control. The first aspect is power, and I would sort of simply put it as step one, is whether you have power over an entity, right? The second is, or step two is, whether you have exposure to variable returns. And the step three is whether with that power, you have the ability to affect those variable returns, right? And all encompassing that is whether you if you consider the purpose and design of the entity which you are currently trying to evaluate whether you control an entity or not. So as I said, three-step model for control. First is power. Second is exposure to variable returns. And third is the ability, right, to affect the variable returns through the power. And if you fail in any of these steps, or if you don't have all these steps together, then you don't control an entity. So I would put it simply in that basis. Actually, in real life examples, things are not that simple as you would see in the examples over. And I'll give you examples in terms of why things are not simple, right? So the definition under IND AS 110 is investor controls an investee when it is exposed as rights to variable returns, right, from its involvement in the investee and has the ability to affect those returns through the power over the investor. And therefore, I've broken this down very easily for you in terms of what the step one, step two, and step three are. So I'm not going to spend time over this, right? Now, this is where things get tricky, right? You need to apply professional judgment in terms of whether you control an entity or not. Remember, right, that only one person controls an entity, right? An entity cannot have two fathers. It cannot have two mothers, right? It's got only one father. It's got only one mother, right? You can't say that entity X also controls the entity Y also controls the entity. It doesn't happen that way, right? One through potentially voting rights, one through shareholding, one through something else. No, there is only one entity which controls the entity, and therefore the judgment in terms of which entity controls becomes really, really important, right? Now, how do you start assessing that? And I've sort of made this simplified through a decision tree, right? If you don't have power over the investee, matter ends over there, right? You don't have control. If you have power over the investee, then the next step is whether you have exposure to variable returns from involvement of the investor. If you have exposure to variable returns through the involvement of the investee, then step 3, you go to step 3, which is ability to use the power over the investee to affect the returns. In either of these scenarios, when you conclude that you don't have any of these, which is step 1, step 2, or step 3, then you don't control the entity. It seems very simple, right? When you break that down into steps and say that, look, if step 1 is not met, I don't have power, and therefore I don't control the entity. If step 2 is not met, even though step 1 is met, again, I don't control the entity. If step 3 is not met, but step 1 and step 2 is met, again, I don't have control over the entity. And therefore, it's quite simple the way the standard is worded. But, you know, in real life, there are various examples, and those examples then would make it difficult for you to apply this judgment in practice or apply the principles in practice. And we'll go through that in some time from now, right? Now, consider the purpose and design of the investee. So if you would see, right, in this box, which is the gray box on the right hand side, I said consider the purpose and design of the investee. And therefore, when you consider the purpose and design of the investee, right, what is it that you would consider over here, right? You would consider what are the relevant activities. The first and the most important step is to identify the relevant activities of the entity. And, you know, in certain cases, the relevant activities of the entity is very, very simple. In certain cases, the relevant activities of the entity becomes complicated, right? Then, once you determine what the relevant activities of the entity are, you determine how the decisions about the relevant activities are made, right? Then, who has the current ability to affect those relevant decisions, right? So the first step is determine what the relevant activities are. Second step is you determine what are the decisions about the relevant activities are. Third is you determine the current ability to direct the relevant activities. And fourth is then you determine, right, who receives the returns from those relevant activities. And therefore, if those 4 you are able to answer, you then would be in a decision to determine the next steps in terms of power, whether the power is substantive, what are the relevant activities, and so on and so forth, right? Now, before we jump into some examples which I have in the background, right? Let me give you examples which is not written on the slides, but which happens practically, right? For example, you know, entity A, you know, has basically, you know, let's assume I'm talking about entity A over here, which you are trying to determine whether that is being controlled by any other entity. And entity A, let's assume, is an entity, you know, which is an alternate, or it's an alternate receivable entity, or ARC, as you would call, right? Now, what does ARC do? If you would look into the RBI regulations in terms of what an ARC does, right? Let's assume that SBI or HDFC Bank, right, has got bad loans. Now, what SBI or HDFC Bank does is, right, it floats an ARC under a trust. And what that means is, right, that basically it pools all the bad loans from various sort of sectors. For example, let's assume this ARC handles a package of bad loans or non-performing loans, as you would call, relating to, let's assume, personal loans, credit card loans, right? Let's assume corporate loans, and so on and so forth. So what HDFC Bank or SBI does in this particular instance is, right, it pools, let's assume, loans which is originated in 2018, 2019, 2019, and 2020 as far as personal loans is concerned, which is non-performing at this point in time, and then floats an ARC, right? And then essentially sells that loan to that ARC. Now, at this point in time, you then need to determine what is the purpose, what are the relevant activities of the ARC. Now, the relevant activities of the ARC in this particular instance is to go and collect, right, the cash from those loans which has gone bad. So at the time when it is set up, right, SBI says that, look, in my books, the total value of the loan is $100 million. And I'm using dollars as a proxy to rupees. And therefore, in your mind, you can essentially put it as rupees. But I'll use dollars as an example because it's easier to understand dollars. Let's assume $100 million is the total value of these loans, right? In its books, assume SBI or HDFC Bank says that, look, I have made a provision of 50 million for that. And therefore, the net value of that book is 50 million. Now, this book is got basically loans from various people whom that loan is being given to. And it goes and essentially parks it in an ARC, which is floated by SBI or HDFC Bank, right? After taking due approval from RBI and so on and so forth, right? Now, it estimates that basically the value of that particular ARC or the fair value of that book is approximately $50 million, right? Now, let's assume that there is a third party who comes and invests in that ARC, right? The third party obviously will do due diligence as far as that particular ARC is concerned. And then it goes back to SBI or HDFC Bank and states that, assume for a moment that it is Axis as an example, right? Or assume for a moment that, let's assume it's ICAI as an example. It goes back and states that, look, SBI, look, HDFC, I think the value of this is not 50, but the value of this is 30, right? Now, SBI comes back and says that, no, I believe it is 50, right? But you are saying it is only 30. So then what Axis or ICICI Bank does is, right, and this is a real life example, is what ICICI Bank or Axis does is, it says, look, my sort of historical pattern suggests that you will be able to collect only 30. And therefore, if you want me to invest in that ARC, right, I will be able to give you only 30. Or I will give you 50. But basically, if you collect anything less than 50, right, then you need to give me back that amount. For example, let's assume that basically I collect only 30 because the collection agency in this particular instance is either HDFC or SBI only. And they come back and say that, look, I am able to collect 50. Axis says you'll be able to collect only 30. So Axis will still pay 50 in this particular instance, but it will say that if I don't get 50 ultimately when the individual loans wind down as far as this particular investment is concerned, right, you would need to fund me the difference between 50 and 30 because I thought the valuation was 30, right? So SBI agrees, HDFC agrees, and basically 50 gets invested, right? Now, one way of looking at it is basically, and this trust or this ARC operates independently, because the only purpose of this is essentially to collect and pay. Let's assume if it collects greater than 50, right? It will pay the amount which is greater than 50 to SBI, right? Because the remaining 50 is essentially being contributed by Axis. But if it collects less than 50, then it needs to pay 30 to SBI, and 20 ultimately would need to be funded by, or it needs to pay 30 to Axis, but 20 would need to be funded by SBI to the trust, and trust then to the Axis. So when you're trying to sort of evaluate what the relevant activities of this particular ARC is, the relevant activities of this ARC is to collect and pay cash, right? How decisions about the relevant activities are made. The decisions about the relevant activities as far as this trust is concerned is determined at inception, or what you call in an accounting language as autopilot. Now, what do you mean by autopilot is basically when you put a flight on a simulator, right? Generally, you would see pilots putting the flight on a simulator path. What that means is that the flight will follow a simulator path. For example, you're flying down from Bengaluru to Bombay, or you're flying down from Bengaluru to Chennai. They will put you on a flight simulator. What that means is it's going to follow a path. So the same way, there are entities which are established with a particular purpose, and it will follow that purpose, right? And therefore, those decisions about the relevant activities are made at inception. There is no further decision which is required to be made, because the only purpose of that is to follow that particular path. Then you need to determine what is that decision, what happens if there is a loss, who is able to fund this loss. Now you will be able to relate back to me, right? Because these kind of transactions were the transactions which were kept out by the banks in 2008 and 9, right? Now you would imagine that in this particular case, SBI is actually underwritten 20. So in the separate financial statements of actually SBI, right, you would need to provide for the fair value of the guarantee of the 20 which they are made, which is the difference between 50 and 30, right? Whereas in the consolidated financial statements, I have actually never lost control of those loans, because practically, right, even though I have made a provision of 50 in the books and therefore I am carrying 50, a third party is coming back and saying that the worth 50 is actually only 30 in this particular instance, and therefore there are two aspects. The first is whether you should be consolidating 100 with the net non-performing assets of 50, and then subsequently you also then need to determine in this particular instance whether I need to provide for an additional 20 or not, right? Now, who's got the current ability to direct those relevant activities? In this particular instance, right, the current ability to direct the relevant activity is determined by what you are doing at inception, or what you are doing through an autopilot mechanism, and who receives the returns from those activities. Technically, the returns of Axis is fixed in this particular case, because Axis is underwritten its risk, right? Or ICICI Bank is underwritten its risk. Who is having the risk in this particular instance? It's either HDFC Bank or SBI in this particular case. And therefore, this is where it becomes tricky, right? In terms of what the purpose and design of the investee is. Take a simple example, and what I didn't want to scare you with a complex example, but this is what you deal in real life examples as far as this particular instance is concerned. In majority of the cases, a parent through an ownership interest which is greater than 50% would control an entity, right? But there could be various instances where there are no control, right? And therefore, those are the instances where you would need to evaluate, right? So I thought, let me give you a real life example in terms of how, what are relevant activities and how decisions about relevant activities are made. But these are the four cornerstones which you would need to establish in terms of what the purpose and design of the investee is, right? Now, power arises through rights, right? Rights is basically through various arrangements, right? It could be voting rights, and therefore let's assume you have floated a subsidiary and you own 100% of that subsidiary, right? The power which the parent has got is through the voting rights in this particular instance, right? The rights can also arrive through a shareholders agreement, right? The rights can also arise through a board of directors resolution, right? The right can arise through, let's assume, a debt agreement. The rights can arise through, let's assume, a vendor agreement. Rights can arise through a customer agreement, right? And therefore, you would see that the rights are divided into 5 parts over here. The first is the voting rights or the potential voting rights. The second is the contractual rights, which is through the vendor agreement or through a shareholders agreement or through a banking arrangement, through a customer agreement. These are something called as a contractual right, right? Then who's got the ability to control the majority of the board and the shareholder, right? Now, for you to determine control, you need to evaluate whether the entity which you are trying to consolidate is a board managed entity or a shareholder managed entity, right? In certain cases, it's very easy. In certain cases, it could be difficult, right? Generally, right, when there are two shareholders who own approximately, let's assume 60% and 40% or 75% and 25% or 49% and 51%, right? You would end up not only evaluating the entity at the board level, but also at the shareholder level. So this is called as a dual governing board mechanism. What that means is that I should not only look into the rights at the board level, but I should also look at the shareholder level, because the shareholder level rights could overrule the rights at the board level, right? And therefore, when you have a dual governance board mechanism, you should also evaluate the rights at the board level and also the shareholder level, right? Then, as I said, when you're evaluating the potential voting rights, you should evaluate the voting rights, including all the options to acquire shares. And then we introduce something which is very, very unique, called as a de facto power. Now, you would not have heard about it, or you would have heard about it in some instances. But what that means is that technically, I can control an entity with less than majority of the voting rights if the other shareholders are dispersed and they cannot come together to outvote you in a shareholders meeting. And that's what you mean by a de facto power, right? And globally, when I was in UK, we evaluated this for an entity called Vodafone PLC. Vodafone PLC is the sort of was the parent of Vodafone before Vodafone and Idea merged. Now it is a jointly controlled entity or a associate, or Vodafone India Limited or Vodafone Idea Limited is a associate of Vodafone PLC. So when we were in UK, we evaluated an arrangement in Turkey, wherein we evaluated whether Vodafone, through the de facto power of approximately 42%, was controlling the entity in Turkey. Because although they had only 42% in that entity, we concluded that that Vodafone actually consolidated that entity because it had the power. Now that was under the erstwhile standard. That was not under IFRS 10, but the concept of de facto power actually is transported from IND AS 27 or IAS 27 into IFRS 10, right? Now, does de facto power exist? Given that it's intriguing, let's spend some time in terms of what de facto power is, right? Now, what you do to evaluate de facto power is you compare the voting rights you have vis-a-vis the voting rights which the other investors have, right? Then what is the relative size of your holding versus the other person's holding? And then what you also then do is you will also look into the dispersion of the other parties in terms of what your holding is versus other holdings is, right? So this is the concept of de facto power. So you compare the voting rights of yours versus the investors, other investors, your size of the holding versus other person's holding, right? And the dispersion of yours versus others. Then the concept of basically you also, when you're evaluating it, you also consider the potential voting rights which you have and add it to the voting rights which you have under A, right? And what you have under C. So whether all of that put together results into you having a de facto power under A plus B plus C. If you have a de facto power, then you consolidate that entity at 100% and then show 52%. In this particular instance, let's assume you conclude that with 48% you have de facto power, then you would consolidate the entity and show 52% as NCM or non-controlling interest, right? So it's pretty unique. Let's look into some examples in terms of what de facto power is, and I'll also give you, I'm not aware of instances in the public domain where de facto power has been considered, but it is evaluated in a lot of instances, and it has been concluded it to be a de facto power. It may not come into the public domain, but if you look into some of the examples in the public domain, you would still find de facto power coming into play, right? So what are other facts and circumstances? The practical ability to direct the relevant activities unilaterally. So as I said, something which is unilateral, and what can you look into as far as the practical ability to direct the relevant activities is concerned is who can appoint the KMPs of the investee, right? Can I appoint the KMPs in order to direct the relevant activities of the entity? For example, who can appoint the chairman of the investee? Even with 40%. Let's assume even with 40% stake, I can appoint the chairman of the investee, right? The chairman, let's assume, has got a casting vote. I can appoint the CEO and the CFO of the investee, right? Or I can appoint the CEO of the investee. Then that is a relevant factor which you would consider, right? Then who can veto changes to significant transactions for benefit of the investor? For example, let's assume I can veto the changes, right? Every relevant activity goes into this particular instance, right? Then you would then evaluate this particular thing. These are very, very relevant when you have a big promoter shareholder who is controlling, let's assume 40%, 45% of an entity. And therefore, the question for you really to understand, even if let's assume you're not consolidating that investee, but even from a related party perspective, under IND AS 24 is whether that investee actually controls that investee, right? Investor controls that investee. And therefore, for you to evaluate, you need to evaluate that particular process, right? Whether the investor can dominate the nomination process of that investee, right? Whether the investees, KMPs, or majority of its board are related parties of the investor. So, I mean, you start thinking about in this particular instance, and you would see that, how judgment comes into play in terms of how you need to evaluate other facts and circumstances for you to come to the conclusion whether, the voting rights plus the potential voting rights plus the practical ability to direct the relevant activities affect the returns of the investee, right? The second aspect is a special relationship with the investee. What that means is, whether there is any other relationship with the investee. For example, let's assume the investor not only has got a potential voting right, but also essentially contributes 60% of the raw materials to the investee, right? Then you are thinking about, other relationships which you should consider in place, right? Or there is a significant dependence, economic dependence of the investor to the investee for you to conclude that the economic dependence or the special dependence along with the voting rights in together will conclude that there is a de facto power, right? Now, the larger the exposure to variable returns, the greater you will be able to conclude that you have the power over the investee. Remember that we are not even talking about variable returns over here. We are still under power, and then under power we are talking about de facto power, right? So again, a lot of theory. Let's look into some examples in terms of what it is. So in this particular instance, the example is where the largest single investor holds 48%. And let's assume other investors are 1,000 in numbers. no individual investor holds greater than 1% of the voting rights, and there are no other voting arrangements in place, which means that there are no voting arrangements, or there is no investor body who could essentially garner all the 1,000 people together, for all the 1,000 people to come together to outvote the 48% investor. Then you would be able to conclude that the largest investor has got the power. Then whether they control the entity, right? You would say that the largest investor control, or the largest investor has got power over the investee, right? Because he controls 48%. The remaining 1,000 odd shareholders, or greater than 1,000 shareholders, all contribute 52%. None of them individually is greater than 1%, and there is no voting mechanisms in place for all the 52% to come together and vote. And how do you establish that? You would establish that by going back, right, into history to say that how many of these investors are actually voted on any major transactions which is coming into play. So you go back into the voting pattern of the past AGMs, and then determine in terms of how many people voted. Let's assume that in all major transactions, right, put together only 5% of the 52% voted, right? Let that be a major transaction relating to an amalgamation. Let that be a major transaction relating to an acquisition. Let that be a major transaction relating to a disposal, right? And in all of this, only 5% is voted, right? And there's nothing in place. Then you could conclude that the 48% has got the control. But let's assume in the same scenario that 5% voting essentially is come down to, let's assume, 45% voting, because there are e-votes in place. There is a big proxy shareholder who is actually, or a proxy committee which is coming into play, which says that you guys would need to vote as far as this is concerned, and therefore in that particular instance, right, that 45 could very well become 52 at any point in time. So if there are mechanisms in place for the individual minority shareholders to come and vote, and the minority shareholders have always come and voted, right, then you could end up in a different situation altogether, and the 48% guy could still not control the entity. So it could go the other way around. So don't take these examples sacrosanct. These are examples to explain a particular situation, and therefore going back into history, going back into basically the facts and circumstances is really, really important for you to conclude. So let's take another example, right, where the largest investor is 45%. There are two investors who are the other investors who vote 26%. So 26 plus 45 is 90, or 26 into 2 is 52. 52 plus 45 is 97, and other investors hold 1%. And there are no arrangements affecting decision making. In this particular instance, if you would see, the other two investors can come together very easily, right? So they could come together and outvote you, the 45% in a voting percentage. And therefore, the 45% doesn't have a power, right? So in this instance, you would conclude that the 45% guy, or the largest investor, doesn't have the power, because basically he can be outvoted in a meeting, right? Now, even in this particular instance, so you take this example, 45% again held by the largest single investor. There are 11 investors who hold 5% each. How much time does it take for the 11 investors to actually come together and outvote you in a particular meeting? It's very easy. In this particular day and age when everything is digital at this point in time, how much time does it take for somebody to come and outvote you in a particular meeting? And therefore, you could potentially come to the conclusion that you don't have the power, right? You still need to evaluate the other facts and circumstances, but unlikely that if there is 5% voting by each of the 11 investors, you could come into a different sort of decision making, right? Now, if you have power, right, you assess power at a legal entity level. If you don't have power at a legal entity level, you can still have power through something called as a silo. Now, what is a silo? Silo is an entity which is ring-fenced from a legal perspective, right? And let me give you two examples to explain what is a silo, right? Now, and I'll take these two examples. I don't know how the practitioners are assessing it, but let's assume that you are a PE investor, right? Let's assume you are a private equity investor, and a private equity investor wants to invest, right, in an educational institution in India. Given that a majority of you guys are from Chennai, or for that matter, let's assume from Southern India, I would take Loyola College as an example, right? Now, for simplicity purposes, the private equity investor wants to invest in Loyola College. Now, Loyola College, let's assume, has got a trust, right? That trust actually has got other investments. Let's assume it's got Loyola College. It is also, let's assume, holding certain investments in Malhar hospitals, right? And other educational institutions across, let's assume, Southern India, right? Now, this private equity investor, right, is not interested in Malhar hospitals, right? It is not. It is interested only in Loyola College, right? Now, what it does is it enters into an arrangement with the trust, right, and says that, look, I am willing to fund Loyola College, right, provided you have a separate bank account for Loyola College through the trust, right, and you monitor, even though the trust will prepare a consolidated financial statements or a financial statement which has got, let's assume, Malhar Hospitals, Loyola College, and so on and so forth, right? The bank account of Loyola College would be separate. The excess which Loyola College has got will not go to other sort of institutions within the trust. The deficit would be funded by me, and then I will take the relevant decisions relating to the activities of Loyola College. And that's the agreement which that private equity investor enters into with the trust, and trust then essentially implements that through its activities in Loyola College. For example, let's assume that students would need to pick up books in Loyola College, then the private equity investors affiliated entity will come and sell books. Let's assume if Loyola College would need to appoint teachers and principal, right? This affiliated entity will come, or this private equity investor will say, appoint Mr. X as the principal, appoint Mr. Y as the teacher, right? Then what happens is all the school fees or the college fees, which essentially this entity has got, would need to be essentially deposited into a bank account. And then all the expenses of Loyola College would also need to go into a particular bank account or a plethora of bank accounts. And at the end of each month, right, there would be a deficit or a surplus which would be taken. And then if there's a deficit, the deficit would go into this trust, from the trust to the P. And basically, if there is a surplus, again, it will go to this particular entity. So you could see in this particular instance, in terms of how that Loyola College bank account is acting as a silo. Silo means separate entity within a particular entity, right? It's acting as a silo, right? And in this particular instance, then you need to evaluate whether Loyola would need to be consolidated by this private equity, right? Now, that's a very, very simplistic way for you to explain how silo operates, but it can really, really get complicated. We have seen examples of silo in educational institutions. We've seen examples of silo in hospitals. You've seen examples of silo in CSR entities, right? Assume, I mean, you would have seen the CSR regulation at this point in time in terms of how, let's assume, when an entity funds CSR, how they need to sort of implement. So the implementing agency would need to have a separate bank account for each of the funding done by the companies. For example, let's assume there is one implementing agency which essentially implements activities relating to, let's assume, TCS, Infosys, and Wipro, right? Now, given that it is implementing the CSR initiatives of TCS, Infosys, and Wipro, right, together, it needs to have separate bank accounts for each of that. You can't mix up TCS with Infosys, Infosys with Wipro, right? You can't do that. And therefore, potentially, you will end up, right, having the implementing agency as a silo. Now, really, from a consolidated financial statements or a separate financial statements perspective, it really doesn't matter, because you need to expend 2%, and that is what ultimately comes into your separate financial statements. Because even at the end of the year, if you have any money, that money would need to be given by the implementing agency back, right, to either TCS, Infosys, or Wipro. In this particular instance, because the way CSR regulations have been written now, the CSR regulations are pretty watertight at this point in time. And therefore, right, you think about your ecosystem and you could find various examples of silos coming through. And this is what we actually see in practice. I thought, again, I should share you real life examples rather than sort of boring you with diagrams. But these are real life examples which we see, which we need to evaluate as far as the entire arrangement is concerned. Right? The next is power. And power would need to be substantive. What that means is that I should be in a position to essentially exercise that power to affect the variable returns of the entity, right? Now, for it to be substantive, I should have the practical ability to exercise the rights. The practical ability to exercise the rights should be the current ability to direct the relevant activities. There are barriers to exercise the voting rights, right? You should evaluate the barriers to exercise the voting rights. Potential rights, substantive if ability to exercise when decisions on relevant activities are made. Investors having only protective rights cannot have the power over the investing. So as I said, if you are having only protective rights, you don't have the power. But when you are evaluating the power, you need to evaluate the practical ability to exercise, the current ability to exercise, what are the barriers to exercise, and then determine whether you have the power. In a majority of instances, you will be able to determine it very simply. But there could be instances which are special purpose vehicles, right, which have been designed with a specific purpose for you to determine whether you have the power over the investee or not, right? And you have this elasticity, right, when you have a promoter and you also have a PE investor, right? Or there are two potential PE investors who are trying to invest in a particular entity. Who's got power over other, right? And therefore, these aspects really then become important, right? Then, the note on potential voting rights. An investor may hold any instruments such as share warrant, share call options, debt or equity instruments issued by an associate. On terms of the instrument is that the holder will get an equity right on the expiry of the term. That is, they are convertible into ordinary shares to give the entity additional voting power or to reduce another party's voting power. And therefore, you not only need to consider current voting rights, but also potential voting rights. Potential voting rights could be a convertible instrument, could be a share option, could be a share warrant, could be a preference share, could be a loan arrangement, right? And therefore, the potential voting rights would need to be considered. The only catch over here is it should be a current or an existing voting right which you should be considering, right? For you to determine whether you have a significant ability to affect the returns through the power. Okay. So how do you again evaluate? Again, I put this in an example, put a diagram, right? The first for you to determine is, does the holder have the practical ability to exercise the right? The holder does not have the practical ability to affect the or exercise the potential voting right, then the rights are not considered to be substantive. Then, are there barriers that prevent the holder from exercising the potential voting rights? If there are no barriers, right, then you determine whether the holder will benefit from exercising the voting rights. If the holder will benefit from the exercising the voting rights, then are the rights currently exercisable, right? And if they are currently exercisable, then you would consider the potential voting right for the purposes of determining whether you have power, right? feels very complicated, right? I mean, the way the standard is written, it's a big change compared to what we had under our existing Indian standard and also under IND AS 27 or IS 27. But if you start sort of putting the example or the decision tree in practice, you would see in terms of how we apply that guidance into practical application. Then let me give you some facts over here, right? The investee has an annual shareholder meeting at which decisions to direct the relevant activities are made. So the decisions about the relevant activities are made only in a shareholders meeting, right? The next set of facts is the next shareholder meeting is supposed to happen in 8 months' time, right? Then the next set of facts is shareholders that individually or collectively hold at least 5% of the voting rights can call a special meeting to change the existing policies over the relevant activities, but such notice requires at least 30 days. So people who have greater than 5% can call for a shareholders meeting, but it requires at least 30 days for you to call a shareholders meeting, right? Policies over the relevant activities can be changed only at special or scheduled shareholder meeting, which can be called in 30 days or in 8 months' time, right? The approval of material sales of assets. So what are those relevant activities? Material sales, right? Then sale of assets, acquiring or disposing of significant investments, and so on and so forth. So then with these current set of facts, how will you evaluate whether you have a potential voting right which you need to consider or not, right? Now, an investor holds a majority of the voting rights in the investment, right? In this particular instance, what happens? The second is the investor is a party to a forward contract to acquire the majority of shares in investee. The forward contract settlement date is 25 days, right? Now, investor is a party to a forward contract to acquire the majority of shares in investee. The forward contract settlement date is 6 months. So you have a potential voting right, which is a forward contract. In the first instance, you can exercise that voting right in 25 days, right? And the second instance, you can exercise the voting rights in 6 months, right? So let's now look into how we assess it. An investor holds a majority of the voting rights in the investee. If the investor holds a majority, given that the investor's voting rights are substantive, because an investor is able to make decisions about the relevant activities, the investor controls the entity, right? Now, when let's assume another investor is got a forward contract which he can exercise in 25 days, right? The investor can control the entity because he can exercise the voting the forward contract in 25 days, and if he exercises the forward contract in 25 days, right, he can then call for a meeting, and when he calls for the meeting, basically, right, within 30 days the meeting can be held, and within the 30 days essentially decisions about the relevant activities can be changed, right? Now, if an investor is a party to a forward contract to acquire the majority of shares in the investee, the forward contract settlement date is 6 months. The forward contract is not currently exercisable, right? Because for you to change the relevant activities, right, you would still need to call for a meeting, and that meeting can be held within the 30 days time period, right? So you can't change the relevant activities because you still don't have the power, right, through the forward contract to change anything relating to the relevant activities are concerned. And therefore, even though you have the potential voting right, given that it is not currently exercisable, you don't control the entity. So you can see in these examples in terms of how potential voting rights come into play in terms of you determining whether you have the power or not, right? So that's basically what you have as far as the potential voting right is concerned, right? Now let's look into some more examples, right? Now A, B, and C own 60%, 20%, and 20% respectively in entity D. Decisions on the relevant activities of D are based on majority of shareholders meeting subject to supplementary right. Right? B and C have a supplementary right at shareholders meeting if either disagrees with proposals regarding relevant activities made by A. If B or C excises as supplementary rights, proposals can only be approved by shareholder holding at least 75% of the voting rights. So which means it's like a special resolution, right? So in this particular instance, you can see how B and C can come together and not allow A to function even though A has got majority of 60%, right? Because decisions on relevant activities can be made only with 75%, and 75% would mean that B and C, either B or C would need to come together, or B or C would need to vote with A. In this instance, given that B, it's not necessary for B and C to vote with A. A does not control entity D, right? So the rights which is held by B and C are not protective rights. They are actually participative rights in this particular instance, and they are actually a blocker for entity A. It's like simply put an instance. Let me give you an example which is happening in real life, right? We talked about China blocking, US and India's resolution to bring the 2611 perpetrators back into India, or call them as terrorists, right? So by merely blocking, right, the resolution, the Security Council resolution of India and US was not passed by China, right? And therefore, from that particular perspective, that particular person or that particular entity was not called as a terrorist organization, right? This came into play wherein a veto right was given to all the five, Security Council members, the permanent Security Council members, to outvote a resolution, and therefore you've always seen that either US outvotes China or China then outvotes US, and therefore that veto rights essentially is got a lot of power. So in this particular instance, B and C have got veto rights, and B and C's veto rights actually prohibit A from controlling entity D. Right. So let's look into another example. Right. In this particular instance, A has got 70%, B has got 30%. B has got a fixed price option. So B's option is deeply out of the money, right? But expected to remain so for additional 2 years term. A is directing the relevant activity. So A currently is directing the relevant activities, right? In this particular instance, the question really is whether the voting rights of B or the potential voting rights of B considered to be substantive. In this particular instance, given that the option is deeply out of the money, right, and expected to remain so for an additional 2 years, it is not considered to be substantive, right? Now, let's take another example, which is on the right-hand side, where A, B, and C hold 33%, and B has got a convertible debt of 27%, right? Now, if it converts, B's shareholding then would change to 60%, right? And therefore, even though the convertible debt is deeply out of the money, right, still I am willing to pay the additional money or the premium because B's business is closely related to investors' business or the investee's business, right? So if the investee's business is closely related to B's business, I'm still willing to pay for the synergies which I am expected to bring through, right? And therefore, in this particular instance, you would conclude that the potential voting right of the convertible debt is basically substantive in nature, right? I mean, you've seen multiple instances in real life. You've seen competition actually coming through. You've seen basically Elon Musk acquiring Twitter at $49 billion, which was significantly higher than the market price of Twitter at that point in time. And therefore, there are real life examples of people paying premium to acquire an entity, right? And in the PE world, you've seen crazy valuations, right? You've seen valuations actually going to a significantly very, very high level. For example, you've seen Paytm getting listed at probably around $20 billion. And then, if you look into the current valuation as far as Paytm is concerned, it's significantly low. So we have seen crazy valuations, and therefore, please don't be surprised that even though a potential voting right is out of the money, it could still not be invested by an entity which has got an interest in that particular entity. So we have really seen examples actually coming through where valuations are skyrocketed, and therefore from that particular perspective, you should not be surprised, and you should not conclude it otherwise when a convertible instrument is out of the money. I just given, even though those examples are not related, I would want to give you examples which are sort of close to the marketplace which has happened for you to realize that things can happen this way, right? So in this particular instance, you would see that potential voting rights give entity B the power, right? I will go through a couple of examples before I delve into some of the other topics. Entity E has 4 shareholders: entity A, entity B, entity C, and entity D. Entity A owns 40% of the ordinary shares of entity E, while each of the other shareholders own 20% each, right? The relevant activities of entity E are directed by its board of directors, comprised of 6 directors, 3 appointed by entity A and 1 each by entity B, C, and D. Separately, entity A and B have entered into a contractual arrangement that requires a director appointed by entity B to vote in the same way as the directors appointed by entity A, right? Absent other factors, the fact that the contractual arrangement effectively gives entity A majority of the votes at board meetings in relation to the relevant activities provides entity A with power over entity E, even though entity A does not hold a majority of the voting rights in entity E. So we do see these examples in practice. For example, a promoter shareholder could enter into an sort of arrangement to vote in concert, right, with other shareholders. I know that SEBI has got now a disclosure requirement for people to vote in concerts, but we have seen this in practice where a big institution or a big insurance company would potentially vote in concert with a promoter shareholder, right? And therefore, you should watch out for this. We should watch out for the disclosures, which is essentially put out by SEBI. There is a lot of transparency which the market regulator is trying to bring into play, so that there is more and more information which is available to investors at this point in time. But we have seen examples in practice where people vote in concert, and therefore, if they vote in concert, you should consider that a contractual arrangement for you to determine who's got power over whom. Right? I will probably skip some of the examples. Let's look into this example, right? Example 7. Investor A holds 70% of the voting rights of an investee. Investor B has 30% of the voting rights of the investee, as well as an option to acquire half of the investor A's voting rights. The option is exercisable for the next 2 years at a fixed price that is deeply out of the money and is expected to remain so for additional 2-year period. Investor A has been exercising its votes and is actively directing the relevant activities of the investee. In such a case, investor A is likely to meet the power criterion because it appears to have the current ability to direct the relevant activities. Although investor B has currently exercisable options to purchase additional voting rights, that if exercised would give it a majority of the voting rights in investee, the terms and conditions associated with these options are such that the options are not considered substantive. This is what I explained in the diagram above, right? This is another example which I explained with 35%, right? Let's look into this example. Example 9. Investor A and 2 other investors each hold a third of the voting rights of an investee. That investee's business activity is closely related to investor A. In addition to its equity instruments, investor A also holds debt instruments that are convertible into ordinary shares of the investee at any time for a fixed price that is out of the money, but not deeply out of the money. If the debt were converted, investor A would hold 60% of the voting rights of the investor. Investor A would benefit from realizing synergies if the debt instrument were converted into ordinary shares. Investor A has the power over the investee because it holds voting rights or the investee together with substantial voting rights that gives it the current ability to direct the relevant activities. This is again one of the examples which I explained through a diagrammatic presentation, but this presentation would be shared by me with with SIRC. You can go through these presentation. If there are any examples, please do write back to me or to SIRC, and I'm happy to explain. But in the interest of time, I would want to go to the other concepts which is there under IND AS 110, right? So, what are the other concepts under IND AS 110? The other concepts over the IND AS 110 is power over the relevant activities. What are the power activities that significantly affect the investee's returns? How decisions over the relevant activities are made? Activities like purchase, sales, working capital, investments, research and development, and financing. These are the activities over the relevant activities. Activities that most significantly affect the returns. And these are predetermined activities or structured entities, right? And I explained to you the structured entity in terms of what I explained for when I started out the session itself, right? Now, let's look into an example, right? Investor A and investor B, right? Come together to invest in entity X. Assume they have 50% each. Investor A invests 50%. Investor B invests 50% in entity X. Investor A is got the ability to develop and obtain the regulatory approval for a medical product, right? And investor B manufactures and markets that medical product. For example, let's assume that medical product is a stent which you put in your heart or which you put in your brain, right? Now, investor A has got the research and the ability to develop that product and obtain the regulatory approval. And once investor A obtains the regulatory approval, investor B then will market the product, right? And these two guys have come together in terms of doing it, right? Now, what are the additional facts? Investor A has the unilateral ability to make all decisions relating to the development of the product and to obtain the regulatory approval because he's got the ability to do it. And investor B is the unilateral ability to make all decisions about the manufacture and marketing of the product. So you don't interfere in my business, I don't interfere in your business. So you have the specialization in basically obtaining regulatory approvals, I have the specialization in marketing. So which investor, A or B, direct the relevant activities of entity X, right? So this is a question. Now the question really is that if the entity is a development stage entity at this point in time, then potentially the center box then becomes important, right? During the research and development phase of the entity, it may be seen that the R&D activities are the most relevant activities of this entity. And therefore, if it is a development stage entity in which 50% has been invested, then potentially entity X has got the power, right? Now, if it is past the relevant active R&D stage, and if it is a manufacturing stage, right, and this entity will no longer sort of do R&D in future, then potentially entity B has got the control, right? Or, for example, both of them have come together and they will continue to do both these activities on a simultaneous basis. For example, let's assume I'm doing stents at this point in time. After doing stents, let's assume I'm doing a biopharma, right? And let's assume I'm determining, let's assume a treatment for bone marrow transplants, right? And therefore, from that particular perspective, after these stents, I'm going into bone marrow transplants. After bone marrow transplants, let's assume both these entities are, let's assume, going into cancer treatments. And, the entity which is doing all of this is the same entity. Then both of them are controlling the entity, and therefore, right, it could result into a joint control because both those activities are relevant and both those activities are something which is really, really important for the entity to essentially affect the variable returns of the entity. And therefore, you really need to also determine what is the ecosystem, what is it that the entity is doing, which stage that entity is for you to determine, right, who is controlling that entity or what is the relevant activities of the entity for you to determine who is controlling. And therefore, you could see that, how you could come into sort of various answers with the same set of fact patterns over here, right? Now, in the example, I also talked about a securitization vehicle, right? Now, if a securitization vehicle is being created and the only activities of the securitization is to receive cash and collect cash, right? So it receives cash right? And then it pays cash to the investors. Then what are the relevant activities? The relevant activities is to manage the receivables and to manage the cash flows. And therefore, the relevant activities in this particular instance is the securitization aspect in terms of first collecting cash and then paying cash, and then what happens in the case when there is a loss, right? Or when somebody is not paying cash. So a ARC transaction, which I talked about at the beginning of my presentation, right? So this is again something which is really important for you to consider, right? The next is exposure to variable returns, right? Now, as I said, variable returns can come in various forms, right? Now, an investor holds a bond with fixed interest payments. Issue: are these returns fixed or variable in nature for the purposes of IND AS 110? So even though the investor is holding a loan which gives him a fixed interest, right? If he loses it, right, he loses the entire interest and he loses the principal. And therefore, from an IND AS 110 perspective, right, that is considered to be variable in nature, right? Because it is associated with the credit risk of the investor, right? Now, an investor receives a fixed performance fee in return for managing assets of the investor. The fixed performance fee, even though it is fixed in nature, again, it is variable because it is related to the performance of the investor. And therefore, from that particular perspective, again, you would consider that. So, as I said, right, variability, don't consider it only from the perspective of shares, right, which is dividend. You consider variability from loans, you consider variability from convertible debt, you consider variability from basically, preference shares, you consider variability from a contractual arrangement, and consider all of that when you're determining whether you have variable returns or not. And I will give you an interesting example in terms of what a variable return is, right? Let's look into some of the standard examples, and then let's look into some of the interesting examples which I will share with you. Ordinary shares carrying a right to dividends and a proportionate share of residual assets. So right to dividend obviously is a variable return, and therefore it is a variable return. Preferred shares carrying a right to dividends, right? So it's non-cumulative, but given that I've invested in that, again, that's variable. Loan provided to the entity providing the investors with interest income. So for the bank, right, what you have is a variable return, right? Because think about a situation, right, where you are, let's assume, Jet Airways, or let's assume you are Nippon Steel, right? Or let's assume you are Go Air at this point in time, right? Which is all filed for bankruptcy. Now, under the bankruptcy code and under the shareholders or under the banking arrangement, if you start defaulting on your interest and if you start defaulting on your bank loans, then the banks have the ability to appoint directors, right, into the board. And therefore, the ability to appoint directors and manage the relevant activities of that entity itself gives power to the bank. The question really is whether that power is protective or whether it is participative. And therefore, invariably, when an entity is going through bankruptcy, when there is defaults, which is there from banks, when the company is defaulted on its loan, you need to evaluate who is actually controlling the entity, whether the promoter is controlling the entity or actually it is a bank which is controlling the entity. Because practically, the banks through a consortium may manage the relevant activities of the entity, and the promoter may lose power over that entity because he cannot withdraw cash, right? For every relevant decisions relating to that entity, you need to go back to the banks in terms of addressing what they need to do. And we are seeing this in practice in terms of what's actually happening at the IBC level, right? So it's something which is important for you to consider as practitioners. Loan provided to the entity providing the investors with interest income, even though it is fixed rate, doesn't matter. It's still variable in nature. Service contracts entitling the entity service provider with a fixed fee, still variable. Upfront fees received in connection with an ongoing service contract. Given that I have already received the fee and it is not refundable, it is not considered to be variable in nature, right? Now, let me talk about an interesting example, right? You talked about variable returns, and you look into all these examples which I put through over here. All these are financial returns, right? You can also have non-financial returns. Let me give you an example, right? Now, let's assume TCS is got TCS Foundation. Now, the entire activities of TCS Foundation, right, is essentially done through, or the entire activities of TCS is done through TCS Foundation, or the CSR activities of TCS is done through TCS Foundation. Or let me take the example of Tata Steel. Tata Steel, essentially all activities are done through Tata Steel Foundation. Now let's take the activities of Infosys. The Infosys activities is done through the Infosys Foundation. Now, what are the activities which is being done by TCS Foundation? Let's assume that TCS would need to spend 2% of its net profits as CSR, right? Now, what they do is the board of TCS then decides, or the CSR committee of TCS, which is a representative body of the board, decides what it needs to spend on. So let's assume the total amount which it needs to spend on is 1,000 crores, right? It then determines, the board then determines that basically 200 crores would be spent on a hospital to be built in a remote village. 200 crores is, let's assume, to be built on educational activities. 200 crores would be spent on, let's assume, Prime Minister's Relief Fund. 200 crores is, let's assume, to be spent on, electrification in rural areas. 200 crores, let's assume, is to be spent on solar panels to be built, through which you will be able to get renewable energy and so on and so forth, right? Now, it gives all its activities to TCS Foundation. And TCS Foundation, what it does is it goes and spends these amounts. It goes and sets up a hospital in a remote village in Leh. It goes up and sets up a school in a remote activity, right? And so on and so forth. And what it does, it puts its banners as TCS. Or let's assume Reliance puts its banners as Reliance Foundation, right? Now, technically, who is benefiting out of all of this? If you would see, TCS is benefiting out of all of this. Even though it's spending, what it's doing is it's also promoting its brand, right? So the TCS brand is being promoted, the Reliance brand is being promoted, the Infosys brand is being promoted, the Tata Steel brand is being promoted, the Tata Motors brand is being promoted. And therefore, the variable returns is not only a financial return, but also a non-financial return, which is intangible in nature. And therefore, the standard recognizes that through the BC, or the basis of conclusions, and then essentially states that the returns doesn't need to be financial, but even can be non-financial in nature. And you would see TCS Foundation being consolidated. You would see Tata Steel Foundation being consolidated, or technically the Infosys Foundation, even though it's not consolidated, the entire activities of Infosys is essentially being sort of done through the CSR route. And therefore the entire CSR expenses has been essentially established. So you would see that, that there are various ways and means through which variable returns can arise. And it doesn't need to be financial, it can even be non-financial in nature. And non-financial is through brand, right? So I thought I should share the example of real life in terms of what happens for you to understand based on what we have encountered. It's actually exhilarating to evaluate these cases and work with companies in terms of they coming to the conclusions. We have a lot of these cases which are complex, but you ultimately, once you apply the judgment and the principles, you always come to the right conclusion, right? The next is the ability to affect the returns. So consider investment in shares by decision makers. Can the majority shareholders change the decision maker without cause? Who has the decisions over the relevant activities? How is the decision maker remunerated? The greater the variability in the return for the decision maker, the more likely the decision maker is the principal, right? Ability to affect the returns. Consider investment in shares by decision maker. So what is it that I have as voting interest? What is it that I have as, let's assume, investment in shares? can the majority shareholder change the decision maker without cause? And I will talk about that through the alternate investment funds route. Who has the decision over the relevant activities? How is the decision maker essentially remunerated? And what the greater the variability in the return for the decision maker, the more likely the decision maker is a principal. So let's again look into the example, right? Significant activities permitted by decision maker, agreement, and law, right? Then you would essentially conclude that the decision maker is a principal. Broad discretion of decision maker when making decisions, then the decision maker is a principal. Decision maker is significantly involved in designing of investing, determining and scoping of the decision making authority, then he is the principal. The substantive kick-out rights are available, then the decision maker is the agent. Decision maker is required to obtain approval from small number of parties, then the decision maker seems to be an agent. The greater the magnitude and variability of remuneration related to expected returns of the investee, then the decision maker is a principal, right? The greater the magnitude and variability associated with other economic interest, the decision maker seems to be the principal, right? Now you would be thinking in terms of what is Anand talking about? I'm not able to understand this, right? Let me take a broad example to help you understand what this is, right? Now, let's take the example of Brookfield REIT, right? Now, Brookfield REIT is listed in the Indian markets at this point in time. Now, REIT is a real estate structure where SEBI allows investors to invest in the REIT and basically get a fixed return. So the REIT is essentially required to, give away 90% of what cash flows it has got back to the investors, and therefore REIT is very similar to a fixed income product, right? Now, the REIT is managed by an investment entity. That investment entity in this particular instance is called Brookprop Management Services Limited. And what I'm giving you is all practical examples which are available in the public domain. I'm not talking about anything which is confidential. So this is held by Brookprop Property Services Private Limited. Now, Brookprop Property Services Private Limited is a related party of the largest shareholder, right, which is the Brookfield entities which is holding in this particular REIT. The REIT is controlled by the Brookfield entities, which is having 56%, and the investment manager is appointed by basically the Brookfield entities. Now, if the investment manager cannot be kicked out, right, which is Brookprop Services cannot be kicked out, because for kicking out, you again need to have a voting, and the voting is basically 45% in favor of, let's assume, the other shareholders and 56% in favor of Brookfield, right? In any voting percentages, the investment manager cannot be kicked out. So this is again an example of how, these kind of structures are in place in India, and you need to evaluate whether who is holding or who is controlling that particular entity, right? So let me go to assessing control at this point in time, right? Again, let's take a practical example as far as this is concerned. Entity A holds 33.3%, entity B holds 33.3%, entity C holds 33.3% in Sporty Limited, right? Does shareholder A have control over Sporty Limited? Now, the key facts is Sporty Limited is owned by 3 shareholders, owning 33%. Shareholder A also holds debt instruments that are convertible into Sporty Limited's ordinary shares at any time for a fixed price that is out of the money, but is not deeply out of the money. The debt instruments were converted. Shareholder A would hold 60%. Sporty B's business activities closely related to shareholder A. Manufacturing sports equipment. Investor A would benefit from realizing synergies. The debt instruments are converted into ordinary shares. So if you would see, right, in this example, A controls Sporty Limited. So even though, right, the potential voting right is deeply out of the money, given the business of A is closely related to the business of essentially Sporty Limited, right? He will still exercise that potential voting right, or the potential voting right is substantive. And therefore, from that particular perspective, he would still control. This is very similar to the example which I explained earlier, right? So if you would see, right, in summation, what are the challenges which we have in determining whether you are controlling an entity or not? Whether the rights are substantive, whether the rights which you have are protective in nature, whether the circumstances in which protective rights become substantive rights, and when is reassessment required. So these are the challenges which is required because a control is a continuous reassessment process, right? So substantive rights and protective rights, right? Substantive rights give the ability or give the entity the power to control an entity and can take away the power, right? For example, let's assume you have the veto rights, you can take away the power, as I said, right? The protective rights cannot give power over the entity and it cannot take away power from anybody else. And that's how we essentially define what is substantive and what is protective. So even though you may have substantive rights, you also need to be mindful that other shareholders may have substantive rights which can take away power from you. And therefore, if they take away power, you can't control an entity, right? So that's the reason why substantive rights and protective rights are important, right? And as I talked about the example of the bank, right? Once you start defaulting, the banks may have substantive rights which can take away power from a promoter. This is exactly what happened in Jet. This is exactly what happens in other instances where, where you go into a resolution process. And therefore, you need to be mindful of that. Okay. Now, if you have completed with this, then we'll go into accounting for changes in ownership interest. Things will start sort of be, you'll find it a little bit easy as far as this is concerned. So an initial investment, you will apply IND AS 28, IND AS 111 or IND AS 109. You will apply IND AS 28 if you are having significant influence. You will apply IND AS 111 if you are having basically a joint control. You will apply IND AS 109 if you are actually accounting for the investment under IND AS. If you still have significant influence, but you're accounting it under fair value, or if you are holding it only as an investment, which is less than 20%, right? Then you will apply the business combination standard when you acquire control. And then you would apply the equity transaction standards if you are buying out NCIs, right? Once you acquired control and further acquisition of non-controlling interest is considered to be an equity transactions under IND AS 110, and therefore there is no new goodwill which come into play, and therefore the additional amount is recorded under equity. I will put an example to explain this. Even in the cash flow statement, the amount which you paid will be shown as a financing transaction rather than an investing transaction. So let's look into an example. Right, on loss of control, you will de-recognize all the assets and liabilities and then recognize the gain or loss on basically DD recognition. You will see in terms of whether you have lost the complete control, and you will recognize basically under IND AS 28 or under IND AS 109. So it's the opposite of what you recognize under. When you gain control, you would sort of do under the derecognition standard, right? What is the consolidation procedures? You will combine all the like items of assets, liabilities, equity, income, expenses, and cash flows of the parent with those of the subsidiaries. You will eliminate the investments and the intra-group items, and then you will present the consolidation financial statements, right? It's mandatory to follow the uniform accounting policies for preparing consolidated financial statements. And then you should also essentially present the consolidated financial statements using the same currency, which is the presentation currency of the parent generally, right? Non-controlling interest, as we discussed, is something which we present as part of equity. And we will talk about that in some time from now in terms of what this is, right? So we will take an example to present it, and then we will go back to the concepts. Let me present the example to you. A parent entity acquires a 60% subsidiary for INR 300 million, right? So the total fair value of the entity is 500 million. So 60% is 300, and therefore 40% becomes 200, right? At the beginning of the year. The fair value of the subsidiary's identifiable net assets at the date of the acquisition is INR 370 million. In its fair value after purchase, the subsidiary's income statement as it is included in the group's consolidated financial statements, that is after all consolidation adjustments such as amortization of intangible assets, is as follows, right? Profit after tax is 26 million. Tax or profit before tax is 26 million. Tax is 1 million. Profit for the year is 25 million. Profit attributable to the NCI is 40% of 25 million. Profit attributable to the parent is 15 million, which is nothing but 60% of 25 million. What would be the carrying amount of the NCI at the date of acquisition or at the end of the first year after purchase? Assume that there is no control premium. So in this particular instance, you have an accounting policy choice, right, which is available at inception on an acquisition by acquisition. And in this particular case, you have a choice of recording it at 200 million, which is nothing but 40% of basically 500 million. How did I get 500 million, which is nothing but 60%, which is 300 million plus 40%, which is 200 million, and therefore 500. And therefore 40% is 200 million plus basically the 10 million, which I add up, or I could get 40% of 148 million, 370 million, which is nothing but the fair value of the net assets on the date of acquisition. And therefore I will have 148 million plus 10 million, which is 158 million. So you would see how the non-controlling interest essentially changes over the period, depending upon the accounting policy choice which you adopt, as far as this is concerned, right? Now, how do you calculate the goodwill? The goodwill is nothing but the acquisition date fair value of the consideration transferred, amount of any non-controlling interest in the equity acquired, less acquisition date fair value of the net assets acquired. And then you calculate what the goodwill is under IND AS 103. What do? You eliminate the unrealized profits on inventory. Then basically, you also calculate what the income taxes is and eliminate the income taxes is calculated on a standalone basis, but you would essentially recognize deferred taxes for any elimination of profits and losses from intra-group transactions, right? So I'll just pause over here to see whether there are any questions at this point in time. We have completed a substantial portion of the presentation, and therefore, if there is any questions on power, on basically control, I would rather take it now rather than take it at the end. Reman, any questions?
No, sir.
Okay. Okay. So let me just go ahead as far as this is concerned. Right. We talk about unrealized profits. So we have both downstream and upstream transactions from unrealized profits, non-current assets transfer, and income taxes. Right. Now, let us take a scenario in terms of basically deferred taxes. How should deferred taxes on temporary differences arising from intra-group transfers be accounted for in the consolidated financial statements in the below mentioned scenarios? Tax rate applicable to the transferor is higher than the tax rate applicable to the transferee. A parent, an entity taxed at 30% as a subsidiary that is taxed at 34%, right? Towards the end of its financial year, say year 5, the subsidiary sells inventory with a cost of rupees 1 lakh to the parent for rupees 1,20,000, giving rise to a taxable profit of 20,000 and a tax rate of 34%, which is 6,800. The inventory remains unsold with the parent at the end of the financial year. In the subsequent financial year, the parent sells the inventory to the third party for rupees 1,50,000, right, giving rise to a taxable profit at the parent entity of 30,000 and a tax of rupees 9,000. In the consolidated financial statements of the parent entity for year 5, the profit made by the subsidiary on sale to the parent is eliminated. Right? Scenario 2, tax rate applicable to the transferor is lower than the tax rate applicable to the transfer. The facts are the same as in scenario 1, except that the tax applicable to the parent is 34% and the tax rate applicable to the subsidiary is 30%. Right? So this is the opposite, where the parent has got a higher tax rate compared to the tax rate of the subsidiary. So in both the above scenarios in the consolidated financial statements, the gain of rupees 20,000 on intra-group transfer is eliminated because intercompany transactions will get eliminated because the inventory still is held, right, in the group, and therefore the intra-group transactions will mean that the tax rate gets eliminated. The tax base of the inventory held by the parent, on the other hand, changes to 1,20,000 due to intra-group transfer. In this particular case, the tax base of the inventory in the books of the parent is 1,20,000, and therefore, in this particular case, you will have a current tax liability of 6,800, which is coming from the subsidiary, which is nothing but 34% of 20,000, which will be the current tax expense. Right? The consolidated financial statements also recognize the deferred tax income or an asset on the temporary difference of rupees 20,000, which is nothing but the carrying amount of 1 lakh and a tax base of 1,20,000. So the tax base is 1,20,000, carrying amount is 1 lakh, and therefore you have a temporary difference or a temporary difference of 20,000. And the temporary difference of 20,000 you will multiply by the parent tax rate of 3,000, 30%, and therefore you will arrive at a deferred tax asset of 6,000. So in this particular case, you will have a current tax expense of 6,800, a deferred tax income of 6,000, and therefore you will have a additional tax expense of 800, which is flowing through in the group financial statements. Right? In scenario 2, what you have is you will have a current tax expense of 6,000, which is nothing but 30% of basically 20,000. But you will have a deferred tax income of 6,800, and therefore you will have a benefit net of 800. So you see that even though the transaction gets eliminated in the consolidated financial statements, because tax is a separate legal entity concept, you will always end up having taxability when the entire transaction doesn't get eliminated in consol, and therefore in an inventory kind of a scenario, you will always end up having either a deferred tax asset or a deferred tax liability to the extent of what the tax rate of the parent is versus the tax rate of the subsidiary is. Right? So I will not take this example. Ultimately, the next example is the presentation and disclosure. Right? You would need to present the significant judgments and assumptions in determining that it has control of another entity. Right? What are the entity, or what are the subsidiaries? What are the entity which has got significant influence? What are the entities which has got judgment? Right? Then you should essentially explain the composition of the group, the interest that NCI has in the group's activities and cash flows, the nature and extent of significant restrictions on the ability to access or use assets and settle liabilities to the group. As far as controlling interest is concerned, for each subsidiary that has NCI, which is material to the reporting entity, the name of the subsidiary, the principal place of business and country of incorporation is different from the place of business of the subsidiary, the properties of ownership interest, as well as the voting rights, if not the same as the ownership interest held by the NCI. So there are expansive requirements which is required. I will sort of leave a minute for you to go through this, but you would, I would suggest you to go through, the ITC balance sheet, the Reliance balance sheet or the annual report, the balance sheet of Tata Motors, the balance sheet of TCS, Tata Steel, the balance sheet of some of the large corporates, right? Unilever, for you to understand how disclosures are made in the financial statements. It requires a lot of efforts in terms of making these disclosures. But given that you have practical examples of going through these disclosures, I've suggested some of the annual reports for you to go through. It's best to go through that. You will understand a lot about the activities of the entity and what each of the entities are doing. Right. So I will pause over here. Rahman, I've completed my sort of presentation. I talked about AIF very briefly when I talked about variable returns. I'm not going to go into detail, but I wanted to cover basically the standard part of consolidation. As I said, the standard is pretty expansive. When you talk about real life scenario, there are judgments involved in terms of consolidating or not consolidating an entity. But the whole objective of the session today was to give you a bird's eye view on what IND AS 110 is all about, and not make you experts. Believe me, as we go through that, even with almost 13-14 years of experience since the standard has been introduced, we get to learn new concepts. We get to see practical examples, and we always apply judgment. The very important part of all of this is to get your facts right, because if you get the facts right, it's very easy to conclude on things. If you don't get your facts right, that's when we struggle in terms of going back and forth in terms of questions and answers about. This is what the industry is learned. This is what the big four auditors have learned and the middle-sized firms have learned. Happy to have any questions if you want to have any questions, or if you want to write in, please do write in to SIRC as well as to me separately. My email address will be shared by Rahman at the end of the meeting. But happy to have any questions at the end of the session. Thank you.
So far, there is no question raised by participants.
Okay.
Shall we end the session, sir?
Yeah, no problem. We can end it.
Okay, sir. So I'd like to propose a hearty word of thanks to our Anand Subramanian sir for making this excellent presentation and making the session interesting and meaningful. And thank you for accepting our invitation for today's session, sir. And thank you all the participants who all participated in this session. Thank you, sir. And we will be circulating the PPT to all the participants, sir.
Yeah, thank you, and thank you for listening patiently. Thank you so much.
Thank you so much, sir.